Hello investors, welcome back to the Mzansi investor channel. It's been a while since we made a video. I was just busy with other things, but now I'm making a commitment that we will be uploading more content in this channel. So the content of this channel will be around dividends. We'll be talking about companies, and also I'm building a dividend portfolio, as you saw in the title of this video. So the things that we'll be covering mostly in this channel, I'll be giving an update on my dividend portfolio, and also I'll just be sharing information about companies, all the communications that we get from the JSE, or sometimes I'll also share information about anything that you can invest in that is outside JSE. We could be talking about the US markets. So far, I'm not trading the Australian markets, so I don't think that in the near future I'll be talking about the Australian market. But the US market will touch some stuff about the the US market as well, in addition to the JSE. So yeah, the purpose of today's video is to just give you a brief introduction of my dividend portfolio that I'm trying to build. So as you saw, the value of the dividend portfolio that I'm building, so that's going to be our baseline. So I want to see, for the duration of this YouTube channel, how far this portfolio is going to grow. I will speak about any contributions, whether we are adding more money to buy more companies that will be adding in our dividend portfolio, or we are making additions to the existing companies that are already present in the dividend portfolio. Even when I exit some of the companies that I already own, I will also give an update there. So yeah, the purpose of that dividend portfolio is to grow it through capital appreciation plus dividends dividends that will be receiving. So at this moment, the plan is to reinvest the dividends back to those companies that will be paying those dividends. But yeah, that's the ideal scenario, that I'll be reinvesting those dividends. If a company pay dividends, I reinvest it. But sometimes it happens that it's not the best time to buy, so maybe I will use that cash to invest in another company that maybe has a better setup, right? So that's just that a brief introduction. And then, if this is the first time you are watching this YouTube channel, please, I would like to ask you that you click subscribe and you hit that bell notification, so that you don't miss any update, as we'll be making updates in the future. For returning subscribers, please like the channel as well. Don't forget to like it. Alright, so the second thing that I want to talk about is how I will be picking these stocks. We've already covered some part of this in the previous videos. The channel has 3 videos. So in the second video, we're talking about the challenges of using a dividend yield as a stock selection tool, because it also has some limitations. Also, technical analysis on its own, it has limitations, right? But the way that I'll be picking stocks, first of all, most of you already subscribed to the Trend Trader channel, so you know that I trade stocks using technical analysis. So it's also going to be the same approach that I'll be using to select my dividend stocks. So first thing first, the stocks will have to meet a technical analysis template that I use to select my stocks, right? So I won't, maybe say for example, a certain company, they declare dividend. I won't just jump and buy that company. Or maybe that company is performing well, I won't just jump and buy that company. Each and every company that I'll be investing in must meet that technical analysis template. It must meet the setup that I always use to invest in a company or to trade a particular stock. So first thing first is technical analysis. Then the second things, there will be some few fundamentals that I'll be looking at in the companies that I own. Such fundamentals include profitability of that business, but the fundamental part is going to come after after I've bought a stock. So before I buy a stock, I look at the chart If the stock meets that criteria based on technical analysis, then I will invest in that company and hold it as one of the dividend stocks in my portfolio, right? So the limitation of that, of just using the technicals first, it's possible that I'll be buying companies that has 0% dividend yield, meaning that those companies, they haven't paid the dividend at least in the past 12 months or so. So that's just one limitation of using technical analysis approach first. So now once I own that particular company, it's there in my portfolio, then now I can start looking at the fundamentals of that company. But it's not like I will buy the company, then go online, search for annual report, financial statement to read up on that. No. If the company release things like trading statements or reviewed financial result, that is when I'll be interested in looking at the fundamentals, right? Because now if I buy a company using technical analysis, then I go look at fundamental analysis or financials, then I find that company is not profitable. That can actually cloud my judgment and maybe make me to second guess the trade or the investment that I've already made. I'm a technical analyst. That's what I use to invest in companies. I never doubt it. I know it works for me. I don't know for you, but I know that it works for me. So that is why I don't want to cloud it with something else. So yeah, once I've bought the company based on technical analysis, then when they release statements, they normally come every now and then. Companies are expected to release result every 6 months, interim results and final results. But also sometimes if they know that the result will differ by 20%, the JSE then tell them that they have to release a trading statement, for example. Or they also just release an update on their own, even if the result won't differ by over 20% or more. So yeah, once I have the company and they release whatever kind of result that they release, what I would like to see is the profitability of the business. If I invest in a company and then they report that for that reporting period the profit is increasing, it doesn't matter how much the profit is increasing. As long as I see that the profit is increasing, I'm happy. So that's one of the fundamental aspect that I will look at. The other aspect that I will look at is earnings per share. So there are two different kinds of earnings per share. There is EPS, which is just earnings per share, but the earnings per share, the EPS, it excludes things such as a one-time event, like if the company is unbundling a certain business, so they don't include that in the earnings per share. But basically with earnings per share, you just want to see that the amount that you've invested is earning some money, right? So now the earnings per share is calculated by the profitability, how profitable the business was. So they use the profit of the business and the outstanding shares. So if you have a positive figure, it means that your rent, every rent that you invested in that particular business, or the share that you bought, has earned a certain amount in rents or in whatever currency that you are looking at. But the key difference between earnings per share and headline earnings per share is that the headline earnings per share will include those one-time or once-off events, maybe a special dividend or they sold the business, all those kinds of things. The difference that earnings per share exclude such information, but headline earnings per share include that information. And also if you see the headline earnings, they report something, then I would be interested to see what was that event that occurred, whether they were selling something or once-off loss from another operation, all those kinds of things. So number one, profitability of the business. Number two, it's that earnings per share, either EPS or HEPS. That's what I'll be looking at. And then just the revenue. I would like to see that the company has revenue that is increasing, because well, revenue is just money coming in. It's not necessarily a profitability of the business. But I just want to see that, I mean, it's a business at the end of the day, I need that business to show that it has the capacity and the capability to bring in cash by offering goods and services. So profitability, earnings per share, either EPS or headline earnings per share, HEPS, and then the growth in revenue, right? Those are the three things that I'll be looking at in terms of fundamental analysis. Then now, because this is a dividend portfolio, we know that inflation is always going to be there. When we invest our money, yes, we want it to grow, but also at the same time, we want our invested capital to retain its purchasing power. So the ideal scenario is that the companies that I'll be investing in, at least their dividend yield beat the inflation, but that's not always going to happen, right? There are some companies at this moment, the inflation is sitting at 5%, right? We had last week the governor of the Reserve Bank, they decided to increase the interest rate, whatever reasons why they chose to increase the interest rate by, I think it's 0.25% or 25 basis points, right? But the inflation is currently sitting at 5%. In the US, they did a lot of printing. Whether it was good or bad, that's for them to decide. Everyone is talking about hyperinflation that is happening in the US. But it doesn't matter whether the inflation is happening in South Africa or it's happening in the US. What you want as an investor is to retain the purchasing power of your capital. So the ideal scenario is that at least the shares that you invest in, they have a dividend yield that is greater than the inflation rate. You're not always going to get shares that have a dividend yield that is greater than 5%, which is the current inflation rate, right? Also, if you look at it at an individual portfolio, you may miss out at some companies. I will just leave the link to the second video that we have where we're talking about the pitfalls of the dividend yield, so that you can understand why dividend yield is not the best measurement matrix when it comes to building a dividend portfolio. But in short, if the share price is increasing, remember the dividend is fixed for the year. You got paid whatever that you got paid. So as the share price increases, the dividend yield decreases. But also, if the share price crashes, the dividend yield increases. We saw that companies like Sibanye, most of the resources stocks, they paid a lot of dividends, but the share price has declined. Some of them has declined by over 20%. So as much as the dividend yield, it seems to be larger, but the value of your investment would have dropped by at least 20%, right? We invest differently. Some people, they just focus on the fact that they still own their shares. They believe that you only lose when you sell. As long as the dividends are coming, they are happy. That's how they play the game. Personally, I always have a stop loss. If a share price drop to a certain level, I then exit that position. I can exit with profit, I can exit with a loss. Anything's possible. I won't allow my positions to go lower than certain percentages. In fact, I rarely exceed minus 10% loss from my enterprise. So yeah, but it's just the way that people do things. We do things differently, right? So again, the ideal scenario is that the dividend yield of that particular company that you buy is greater than 5%. But if that doesn't happen, it doesn't happen. At least at the portfolio level, for instance, if we have 5 shares that we invested in, if we can grow that portfolio greater than 5%, then we will have retained the purchasing power of our capital. But now at the portfolio level, 5% isn't that great, but hey, we have to start somewhere. Just and then the benchmark for that. Okay, so the dividend yield that we are targeting at the current inflation rate, it's 5%. If the inflation increases, we're also going to increase the dividend yield that we would like to have in our portfolio, but at the moment it's 5%. And then also we like to benchmark our performance, right? At this moment, the dividend portfolio that I'm talking about, it's the South African rand. It's going to be South African rand portfolio, or it's a JSE portfolio, not South African ranked. So I'll be using the JSE as the benchmark. Now you can decide whether you are tracking the JSE top 40 or you are tracking the JSE all share index. Some of the companies that I will be holding, chances are they will be outside the JSE top 40. So I don't think that it would be wise to use the JSE top 40 as the benchmark. I think it would be better if I use the all share index as the top as the benchmark, because if the company is outside the JSE top 40, then it won't reflect what is happening with the JSE top 40, right? So the benchmark that we'll be using is going to be the all share index. And the good news is that now Satrix introduced a new ETF. We covered the video in the Trend Trader channel where we're talking about the capped all share index ETF. So we can also use that as to benchmark. We look at the all share index itself, how it's performing, but the difference between the all share index itself and the Satrix ETF is that on the Satrix ETF the holding is capped. So if a company has a percentage that is greater than 10% in the all share index, in the Satrix ETF it's just going to be capped at 10%. No company is going to exceed 10%. But in our case, we're just going to invest whatever amount of money we're investing. We're not replicating the index because we'll be picking stocks. So our portfolio is going to have, at no point I want to have more than 10 stocks. 5 stocks, okay, I'm happy with 5 stocks, or maybe between 5 and 8 stocks, that's okay. Anything greater than 10, then that is just too much diversification, and you end up having an average result. If you have all the stocks that are in the market, you might as well just buy an index tracking ETF, pay 0.1% total expense ratio, assuming you buy the Satrix top 40 ETF, which is, as far as I know, is the cheapest in terms of a total expense ratio. So that's that. So number one, we want to beat the inflation, at least return 5% to retain the purchasing power of our capital. Number two, we are going to be benchmarking our portfolio performance against the JSE All Share Index, right? And I don't like to return what the market is returning. If possible, I want to beat the benchmark. So the best case scenario is that we perform better than the All Share Index. Whether that's going to be possible or not is going to be another story. But the best case scenario, we just want to beat that all share index, right? So now that you have an idea of what I want to achieve with this dividend portfolio, so at the moment I will just pull a picture of that dividend. I will overlay it in that video so that you can see the companies that I'm talking about, the companies that at the moment I've invested in that amount that you see in that description or video description or the thumbnail there. So at the moment I have 5 stocks in my portfolio, right? The 5 stocks that I have here. So I have not a large portfolio, but I mean it's one portfolio in my EasyEquities account. I've split the portfolio. I have a dividend portfolio in there. I have a trading portfolio in there, and also in the Trend Trader channel around July we started a 10,000 rand stock trading challenge. So I have some 10,000 rand that I've allocated to trading, but the overall performance of that portfolio, it just grows because there's the dividend that side, there's the other trading portfolio, and then that 10,000 rand stock trading challenge. If you want to learn more about that, I will leave the link also in the description below, the 10,000 rand stock trading challenge, right? So at the moment I have 5 companies in my portfolio. So I'll just I will pull that banner there, that picture, so that you can see the companies. But there is First Rand, and then there's Remgrow, I have Redefine, there's Shoprite, and then there is Pepco. So as you can see, what are individual companies? It's First Rand Limited and Redefine Properties. So we know that First Rand is a banking company, or it's in the financial sector, but First Rand has different products. There's the bank, then there's car finance, there's insurance in there. But the dividend yield of first rent at the moment, it's 4.53%. It's still less than that 5% that I would love to get, but what can I say? It's 4.5% as it is. And then when you look at Redefine there, the dividend yield is greater than, it's in fact 11.52%, way better than that 5%. But what you need to keep in mind is that earlier this year, Redefine didn't pay dividend. Okay, Redefine, it's a real estate investment trust. By law, they're supposed to distribute at least 75% of the income that they generate from their properties. But in addition to that rule, the company or the trust is expected to do a test whether they can afford to pay that 75%. So at that time, Redefine released a statement to say that they won't be able to afford to pay that amount of money due to whatever. I mean, everybody's blaming coronavirus these days. So now they will be paying a dividend. It's a gross dividend of 60 cents per share that will be paid on the 6th of December. I can't remember when is the dividend date, but the dividend is going to be paid on the 6th of December 2021. So if you look at the dividend yield, it's at 11.52%, which is big, simply because they skipped a dividend in the previous period and then now they are paying a dividend. The share price is still a bit lower, so the dividend yield is high, right? So those are the two individual companies, right? But now if you look at Remgro, Shoprite is also an individual company, even though it has a lot of other umbrella companies underneath. Like under Shoprite, there's Shoprite as itself, there's Checkers, not sure if okay, Hungry Lion, I think it's still part of it. Houses and Home, it's part of Shoprite, but it's still treated as an individual company. And the dividend yield of Shoprite is 2.78%. Most investors, they know that Shoprite is one of those companies that consistently pay dividend. The share price does not necessarily perform better than other companies, but in terms of dividend payment, even during the coronavirus pandemic, they didn't skip paying a dividend. Okay, the share price is currently at 196 rand per share. So the previous dividend, I think it was 2 rand or 4 rand. So the dividend yield is sort of lower because the value or the price of the share, it's a bit high. But Shoprite is one of those companies that does not skip dividend payment. Then we have two holding companies there. We have Remgro. Remgro, it's a holding company. It's listed, and then it holds other companies. Some are listed, some are not listed. For example, Remgro owns Distel. Last week we got the news that, well, long time ago, we heard that Heineken is planning to buy Distel, and then last week they said that Heineken has offered 165 rand per share to the shareholders, or the shareholders can elect to take unlisted shares of Heineken new company, it's Newco. So Remgro, as the holding company of Distel, announced that they will be accepting that 165 rand per share offer from Heineken, and in fact they won't take the 165 rand, they will be taking shares from Newco. I had Distel shares in my portfolio, so I decided to sell my Distel shares there because, I mean, if I elect to take 165 was already less than the 180 that was trading the previous week. Just the previous Friday, Distel was trading at around 81 rand per share. Then on Monday, they made that announcement. The share price dropped all the way to 165. I exited at that level. Well, I made some profit. So we ran out of space as I was recording. So now I'm using a different device. The quality might change a bit. I hope that I won't touch something that I already touched, because I just kept on recording. When I checked, I ended up somewhere where I was talking about this day, right? So I think I've covered Remgro to say that Remgro is a holding company. It has different companies underneath. One of them is Distel, which is going to delist because they've already indicated that they're accepting the offer from Heineken, right? And then Remgro has other companies that are listed, like they own about 30% of First Rand, and also they own a portion of Mediclinic. And then they have a lot of other businesses that are not listed, like a product, DFA, which offer fiber services, right? Then the last holding company that I have is Pepco. We know Pepco, it's a low cost retail company. They have Pep in their portfolio, Pep, Ackermans, and then they also have other different brands. Pepco is partly owned by Steinhoff, so Steinhoff owns about 80% of Pepco. Even though earlier, at some point this year, they sold a portion of the investment in Pepco because they wanted to pay some of their debt. I used to trade Steinhoff. I've made a bit of money from it, but it's just one of those companies that still have issues. You buy the company in the morning, it goes up, then by the end of the day, they release a statement to say that either the Western Cape High Court is doing something, or the company, the court in Europe have done something, and then the share price, it just crashes. So I decided to leave Steinhoff alone. Then I focused on trading Pepco. As it is, I have a position in Pepco that I'm happy with. So the current share price of Pepco, it's around 23 rand per share. And the dividend yield there is 1.88%. They've paid a dividend in the past few days, past few weeks. I don't actually remember when it was paid. So this is my dividend portfolio. I have these 5 companies. It's First Rand, Remgro, Redefine, Shoprite, and Pepco Holdings. I'm not necessarily planning to hold forever on these stocks. I will hold them for as long as they perform better in terms of fundamental, in terms of technical analysis, and also until they have closed to a certain level, right? So now, if you would like to see how I choose these companies, you can go to Gumroad. We have a page there in Gumroad under the banner of Trend Trader. You will see we have an ebook there. The ebook is called the Dividend Manifesto. So there we detail exactly how we choose these particular stocks that we'll be investing in or investing on. The ebook only cost about $5.99, so that's about $6. If you have $6 to spare, please consider buying that ebook. We believe that is going to help you to pick up those dividend paying stocks. You can see there on Gumroad, you can just scroll there, look at the details of the ebook and the performance of the stocks that you have held in the past. Well, past performance is not indicative of the future, but then you will have an idea of the kinds of results that you are able to generate by following those set of rules. And then, like I said, if you haven't subscribed to this channel, please consider subscribing. If you enjoyed the content of this video, please hit the like button. Help us to reach more dividend investors. We will be covering a lot, or we'll be doing a lot of dividend investing content from now on moving forward. We'll be giving update on our dividend portfolio that we are building, that we want that dividend portfolio to outpace the inflation, but also we want to see that portfolio to beat the benchmark, which is the JSE All Share Index. That's what we'll be gauging our performance against. So if you can just be kind and click the subscribe button and like this video, and if you believe that there are some people that can benefit from the content of this video, please kindly share that with other people. So that's it for today. We'll see you on the next analysis, as we'll be making more content. Thank you.